Worries of the second wave of this virus are now coming to fruition, with cases of this virus hitting new record highs in the United States. And now, with states like Texas and Florida rolling back their reopenings, you might be wondering, what does this mean for the economy and the markets? What's up, everybody? I am Jaspreet Singh from theminorityMindset.com and welcome to the Minority Mindset. The United States economy is open and back in business, but it's facing a new dilemma with this virus resurging and hitting new record highs. If you remember back in March or April of 2020, there were a few scenarios as to how this pandemic could play out. Either this virus could just completely go away, or we could have a vaccine or a treatment come in that would drastically reduce the number of cases, or we could see a potential second wave of this virus, which could potentially lead to another round of lockdowns, which could cause a lot of destruction in the economy. Well, it looks like people aren't really worried about a second wave anymore because this first wave never went away. This wave just kept growing, and now we're hitting new record highs, although some states like Michigan and New York did contain the growth of the virus, at least temporarily. At first, no one was really worried about this uptick in cases because it was mainly in young people who were just partying like it's 2019. But now people are starting to get a little bit more worried because hospitalization rates are going up. States around the country are seeing their hospitalization rates go up again, and Texas has been breaking record high hospitalization rates every day for 2 weeks straight. Whether you don't care about this virus or you won't leave your house without your hazmat suit on, you cannot deny the effects that this virus and pandemic are having on the economy and the effects that this virus is having on the economic recovery. Now, obviously, your health is the most important thing here. You cannot put a price on that. So before all else, make sure you and your family are healthy and safe. But this virus is taking a toll on the United States economy. I mean, it just gave a devastating blow to our childhood with Chuck E. Cheese going bankrupt.
No, not Chuck E. Cheese. What am I gonna do with all my tickets now?
Yeah, those are old Chuck E. Cheese tickets that I saved. And yes, I was very sad when I heard that Chuck E. Cheese filed for bankruptcy. Nike lost $790 million and they said that layoffs are coming. Microsoft is shutting down all of the retail stores, and GNC just declared bankruptcy and they're shutting down another 1,000 stores. And now, with the virus growing faster than ever in the United States and a vaccine still a ways out, you have to imagine that the economy is going to continue to suffer. What you might find really interesting, though, is that states like Texas and Florida in May and June were really adamant about opening their economy back up, saying that having the economy shut down was doing more harm than good. But now they're changing their tones. Florida has banned drinking in its bars, and Texas has banned all elective procedures in their hospitals to save hospital beds. Now, this isn't another round of lockdowns yet, but it's a pretty big difference in the tone that, these politicians and governors are speaking about how to handle this pandemic, because just a little while ago, they kept saying that we cannot have another round of lockdowns and that they won't lock anything down again. So this is something you want to pay attention to, because if things continue to get worse, then you have to imagine that they might be willing to lock down again. Economically, we know that lockdowns are destructive. Like, if you run a gym and people are not allowed to work out in your gym, then you're not going to make any money. And if you have to make loan payments and you have to make your rent payment and you have no money coming in, eventually you're gonna go out of business. If businesses shut down, then people lose their jobs. And if people lose their jobs, then they stop making money. And if people don't have money, then they don't have money to spend on other businesses, which means other businesses struggle to survive. And this is what will put the United States into a long recession or even a depression. So we're facing a war or a dilemma between health and profits, and we hope that the people in power can find a way to balance the two so people don't get sick anymore and businesses can start thriving again. The concern that the United States has going into July is that cases of this virus are growing faster than ever, and states are starting to slow down their economic reopenings, and all this free money that was pumping up the markets and the $600 weekly check that people were getting in unemployment is expected to dry up in July unless things change. Naturally, our government doesn't want to see any more lockdowns, but they also don't want to see people get sick, and they also cannot continue to afford stimulus checks and unemployment checks and bailouts forever. But if things continue to get worse, chances are we're going to see more government action, and that all comes at a price. And this brings me to the stock market. The stock market rallied in May and June because cases of the virus started to slow down, economies were opening back up, and the Federal Reserve Bank was pumping an unlimited amount of money into the markets to get the stock market back up. What I want you to remember though is that the stock market isn't a mirror reflection of the economy. The stock market is a place where investors go to put their money based on what they think is going to happen in the economy in the future. In March of 2020, people and investors thought the world was ending because nobody had heard of lockdowns and economic shutdowns in the United States, so the stock market tanked because nobody knew what was going on. In May and June, investors saw the light because economies started to open back up and the cases of this virus started to go down, so everybody thought, okay, the economy is getting better now, so it's going to improve in the future. This feeling of optimism helped the stock market boom. But now everybody on Wall Street is concerned about this optimism going away. Like we've been saying for months now, a second round of lockdowns would have a destructive effect on the economy and more businesses would go bankrupt and many more people would lose their jobs. This is what everyone's trying to avoid. But the flip side is when you open economies back up too soon, or you don't take care of the health issues and things just start going back to normal and people aren't taking their precautions and the virus starts to grow, if things get too bad, then the government might be forced to take drastic measures. This uncertainty could very likely push the stock market back down because if investors are worried about our economic future, the stock market's going to eventually reflect that. This is where everybody says, oh, don't worry about the stock market. The Federal Reserve Bank has my back. Yes, they do. The Federal Reserve Bank has made it very clear that they will continue to pump as much money as they can into the markets. But the risk and the concern is that the Federal Reserve Bank has already pumped a lot of money in the market, so eventually their money effect will start to fade away. They'll just turn on 2 money printers then. This can create a lot of opportunity for you as an investor because what we have seen throughout history is that over the long run, the economy and the stock market and strong companies go up. Our March stock market crash was caused by this pandemic. I mean, there was other economic issues involved, but this pandemic came out of nowhere, kind of like a needle to pop our economic balloon. The May and June stock market rally was fueled by the Federal Reserve Bank pumping up the markets. And now going into July, it's going to be very interesting because the shock factor is gone. If states do decide to lock down again, then people will probably be shocked, but they won't be shocked like they were back in March when it happened for the first time because we've already experienced it. And I really don't think anybody is going to be shocked if the Federal Reserve Bank comes out and says, okay, we're going to print more money and try to prop up the markets even more. This shock factor, while it might not be a super important matter in the economy, it's very important in the stock market because people make decisions on whether to buy or sell stocks based off of their emotions. But if you hear something again and again and again, whether it be the Federal Reserve Bank is printing more money or that guacamole is delicious, eventually you stop caring. Well, I guess guacamole is an exception because you can never stop caring about guac. What I want you to remember is that every economic crisis comes with opportunity for the minority of people who think different, and there will be a lot of opportunity to build wealth through this economic crisis. The people who were buying stocks in March when the stock market was collapsing saw massive returns in just weeks. And now, as we're facing another round of uncertainty and another potential risk of lockdowns happening again, there is a chance that our stock market will come down or potentially crash again. This is where I want you to not think like the majority of people and panic. I want you to come in, be calm, and use this price drop as an opportunity to buy great investments at a huge discount. Now, before I get into specifics of what you can do, let me just remind you, investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so make sure you do your own due diligence and don't just blindly listen to a random guy on YouTube. Trying to perfectly time the market at the top or bottom is almost always a losing game because nobody can perfectly time the market. That's why when I buy stocks, I like to do something called drip buying. Now, you don't have to do exactly what I say. This is just what I do. I have a small list of stocks and funds that I want to own, and I keep an eye on these things, and anytime these stocks or funds drop another 5 to 10%, I buy. And if they drop more, I buy more aggressively. This way, the further down in price they go, the more shares that I buy. Now, I'm not trying to time the markets, and I'm not trying to sell my stocks in 2 weeks or 2 months. I'm expecting to hold for the long term. But now what I'm doing is I'm just waiting and sitting back and letting the prices do whatever they do. And if they fall, I'm going to use this as an opportunity to buy more shares. This way I can accumulate more of the funds and stocks that I want to own at a discounted price. If you want to trade stocks, you have to use a stock brokerage like our sponsor Webull. Webull is a commission-free brokerage. Say they don't charge you a penny to make a trade. That way you can use your money to invest instead of using your money to make your broker richer. They're very easy to use, and they are giving you, Minority Mindset fans, 2 free stocks when you open an account and start investing with them. All you have to do is open up a free account using our link in the description below, and they will give you a free stock. And then when you deposit $100 into your account, Webull will give you a second free stock valued at up to $1,400. Minority Mindset is a partner with Webull, so if you use them, we will get compensated, but there's no additional cost to you. I mean, it's free to open an account, they don't charge you a penny to make a trade, and you can do all of this on your phone. So if you want to get started and you want to get your free stocks, I got the link to where you can do that in the description below. If you are a newer investor and you don't know how to analyze a company, then you should not try to be in the stock picking game. Well, at least not with your whole portfolio. If you do want to be in the stock picking game, use a percentage of your portfolio to do that, especially in the beginning as you're learning, because you'll see that there's more risk involved when you're actually trying to pick stocks. A much simpler option is to invest in ETFs or index funds, which you can kind of think of like a group of stocks. Now, you don't have to worry about investing all of your money into one company and that company potentially going bankrupt, because if that happens, you would lose all of your investment, and that's not fun. When you're invested in an index fund, for example, now you have a fund which is invested in a bunch of different companies. So if one company in this fund goes bankrupt, you're still okay, because there's a lot of other companies in this fund that will help balance out your portfolio. I'm not going to go too deep into this in this video, but this is what financial education is all about. And if you do want to learn more about financial education and money management and investing, we have an ebook that you can read for free when you sign up for our financial education emails, which are also free. You can get a free ebook and sign up for our financial education emails by clicking the link up here or by clicking the link in the description below. By the way, our financial education emails are separate from our financial news emails. Thank you for watching. If you enjoyed this video, share it with one friend, that way we can help spread the word. If you want to learn more about how you can find a good company to invest in on the stock market, I already made a video on this, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.